Financial reporting. Consolidation. Consolidated balance sheet we have covered completely. Let's cover a question from past paper, because this question we need to attempt in Excel sheet. So let's practice one question on Excel sheet, mean how we can attempt question in Excel sheet while sitting in the exam. And then we'll move towards next chapter 19, that is relating to consolidation profit and loss account. So let's see this question. So what you need to do, requirement, prepare consolidated statement of financial position for Dargent company as at 31st March 20x6. Dargent company 31st March 20x6 consolidated statement of financial position. So we are here. Dargent company consolidated statement of financial position as at 31st March 20x6. And we know consolidated financial statements, so we need to write down assets first. And then we need to write down non-current assets in assets. And then current assets, equity and liabilities, so on. So let's make it like that. This is for working. And here we'll write the amounts. So figures in dollar thousands. So let's move toward question. What's the year end? 31st March 20x6. On 1st January 20x6, year end is 31st March. On 1st January 20x6, 3 months before year end, Dargent company acquired 75% of a Latry company equity shares by means of a share exchange of 2 shares in Dargent company for every 3 Latry company share acquired. Okay. On that date, further consideration was also issued to the shareholders of a Latry company in the form of $108% loan notes for every 100 share acquired in Latry company. Mean how many shares they are acquiring. This means against each share they are issuing loan note as well. None of the purchase consideration nor the outstanding interest on the loan notes at 31st March 20x6 has yet been recorded by Dargent company. This means interest note need to record as well. At the date of acquisition, the share price of Dargent company and Latry company is $3.2 and $1.8 respectively. Who is giving share to whom? Parent is giving share to subsidiary. And in share consideration, we need share price of what company? Parent company or subsidiary? Parent company. Parent company. Parent company. Okay. The summarized statement of financial position of the two companies as at 31st March 2026 is a non-current assets, property, plant, and equipment. There is note one as well. Investment in Emery Company. What's your subsidiary name? Latricum. Investment in Emery Company. What is that? We don't know. Could be associate. Current assets, inventory, trade receivables, banks. And under equity share capital, equity shares of $1 each. Both companies share capital given. Retained earning on 1st April 2025 mean at start of the year 20,000, 19,000 for the year. Profit added this mean closing. Retained earning for parent company is 36,000. And for subsidiary closing retained earning is 19 plus 8, 27,000. Mean at reporting date. Okay. Non-current liabilities, 8% loan notes in Dargent company, 5,000. Except this, they have issued more loan note. And current liabilities, both companies are having, and there's some information. So let's make a format first. We know under non-current assets, we are having a property, plant, and equipment. Property, plant, and equipment. Under non-current assets, we are having a investment as well. It's showing like this. Sorry,
Is equals to sign
is equal to sign. We're here.
property in the formula.
Oh, yes. Writing as a formula.
Yes. Because there's a subtraction of zeros.
It's fine now. Okay, next we are having investment in army as well. Mary. And then we need to write down goodwill. And then we'll move towards current assets. Under current assets, we are having inventory. It's not given there, but we need to calculate goodwill. Okay. Because they haven't recorded that consideration yet. Whatever the share option, they haven't recorded yet. There is no cash consideration. There is share consideration and contingent consideration of loan note. I mean, two considerations are there. Okay, we are having inventory, we are having a trade receivables. We are having a bank. And then we will be able to calculate the total assets. And then we will move towards equity and liabilities. First we will write equity. Under equity, we are having a share capital. Yes, equity share. We are having a retained earnings. We need to record a non-controlling interest as well. Then we will move towards non-current liabilities. The non-current liabilities, we are having 8% loan note. We are having current liabilities. This information we are having. And we will calculate total equity and liabilities. Whatever the figure we can put as it is, let's start putting those figures. So in bracket, simple in working, we need to add property, plant and equipment 75 200 plus 31500. The remaining what we need to make adjustment we will see later on. Regarding this investment AMRI, that is 4500. Regarding inventory, we are having a 19400 plus 18800. Regarding a receivable, 14700 plus 12500. Regarding bank, we are having a 1200 plus 600. Regarding share capital, we need to record only for the parent company. That is what 50,000. Regarding retained earning, we need to calculate. Non-controlling interest, we need to calculate. 8% loan note, we are having a balance of how much? 5,000 already. And regarding current liabilities, we are having 24,000 and 16,400. Now we'll move towards adjustment. And we know we need to prepare some of the working as well. So let's start those working as well. Working one. And working one, we prepare normally for what? For holding. Holding is there. 75%. Who is holding whom? Dargent holding. Dargent holding 75% of Latry. So put there Dargent. 75% of what? Latry. At what date? What's the date? 1st January 20x6. 1st January 20x6. So Dargent holding Latry 75% on what date? Is on 1st January 20x6. That is till year end 3 months. Okay. Next, move towards working 2. So working 2, that is net current assets. Net assets of subsidiary. And regarding net assets of subsidiary, we need to prepare some columns. We need to find the figures at acquisition date. We need to find figures at reporting date. And we need to find the difference. So let's make them a little bit bigger. Okay, and we are having some information about them. Share capital we are having. So shares information we are having at acquisition date, they are 20,000 and they remain same at 20,000. So there is no difference. What else information we are having? We are having retained earning information. How much is the retained earning at acquisition date? We don't know. But we know the retained earning at reporting date are 19 plus 8, 27,000. Can we find retained earning at the reporting date? If this profit during the year is 8,000 for the complete year, this normally profit is written for the complete year. How much we need to add here? 3 months. How much we need to add here? 3 months or 9 months. 3 months. At the date of acquisition, we need to know what is the profit. So 3 months post-acqui, 9 months are pre-acqui. So out of this 8,000, how much is pre-acqui? Pre-acqui, that is 6,000. So we can calculate this how 19,000 was initial, 19,000 was initial, plus we need to add how much out of this 8,000 multiply by 9 divided by 12. Because at the date of acquisition, we need to know how much was profit. If 8,000 is for complete year, this means 9 months was before acqui, 3 months after acqui. If we see what's the 3-month profit, that is 2,000. This means 6,000 is pre-acqui. So at the date of acquisition, the profit is what? 25,000. And the difference made during the year, during after acquisition, that is 2,000. Can you understand this? Okay, let's move towards working 3. What's the next working? Normally, goodwill. So working 3, that is of goodwill. And in goodwill, we need to record first what consideration paid. From consideration paid, we need to add non-controlling interest and we need to deduct. So in that, we need to add what fair value of NCI at the date of acquisition. And from that, we need to deduct what fair value of net assets acquired. So we can calculate goodwill. If there is impairment, we will deduct that. So leave 2, 3 lines and then move towards working 4. That is about what? Non-controlling interest. And then in non-controlling interest, we need to record a fair value at acquisition. We need to add what? Subsidiary profit share. We need to see if there is any impairment. We need to deduct. So leave 3, 4 lines and move towards working 5. That is about consolidated retained earnings. And in that, we need to write down a parent retained earning. That we need to add subsidiary profit share. And we need to deduct something. So leave space regarding that. Make it bold so that we can identify separately. Okay. So on 1st January 2026, Dargent company acquired 75% of Latry company's equity share by means of a share exchange of 2 shares in Dargent company for every 3 Latry company shares acquired. How many shares Latry company is having? 20,000. Out of that 20,000, how many you are acquiring? 75%, this means 15,000 they are acquiring. So we are going to calculate consideration. So make one more working here, working 6. Out consideration paid. So acquired share are how many? 20,000 into 75%. So what is that? 15,000. Okay. Now you are issuing shares. 15,000. Against 3, you are issuing how many? 2? So multiply by 2 divided by 3. How many are these? 10,000. So 10,000 shares you are issuing. What's the price? So share consideration is 10,000 shares multiply by what's the price? 3.20. So what's the amount? 32,000. So this is the share consideration that you have issued. And out of this 32,000, there is some part of share capital, some part of share premium. How much is the share capital in that? How much is share capital in that? 10,000 shares you have issued. Multiply by 1. So share capital is what? 10,000. What is share premium? That is 10,000 shares you have issued, multiply by remaining 2.20. So share premium is what? 22,000. This means in consolidated financial statement, there should be a share premium account as well. If we move towards consolidated financial statements, is there any option for share premium? No, we need to add here. So right click, insert. So we can add here share premium. That is what? 22,000. And in share capital, 10,000 more we need to add. 10,000 more we need to add. Is that how much share capital will be there? 60,000. Okay, move towards working again. So share consideration we have calculated 32,000. Now we need to calculate consideration for loan note. Consideration for loan note. What's the information is? On that date, further consideration was also issued to the shareholders of Lottery Company in the form of $108 loan note for every 100 share acquired in Lottery Company. How many share you acquired of Lottery Company? 15,000. How many shares you acquired? 15,000. So now we are moving towards calculation of loan note. So we issued 15,000 shares. And they are providing against 100 each. 100 mean the consideration will be 15,000 same. So total consideration 32,000 plus 15,000 is 47,000. Is working 6. We have found the consideration paid for goodwill. Consideration paid from working 6. We have found that total consideration is 47,000. Is that? Yeah. So this first paragraph is done. And there is a share price of lottery companies also given. And they don't mention share price without any reason. Let's see how, where we can use this information. Okay. So let's move forward. This means in loan notes, we need to add this 15,000 as well. Under balance sheet loan note, we need to add this 15,000 as well. Is that? Okay. And there was some more information about loan notes. What was that? Interest is accrued. What is the interest on loan? If we move towards here, interest on loan note, amount is 15,000 and 8% is the interest rate is equal to what? 1,200 for the complete year. How many months? 3 months. So it need to be multiplied by 3 divided by 12. What's that? 300 is the loan interest that haven't paid during the year. Where it should be recorded? Current liability. Current liability. Where else? Expense for the year. In P&L. We are in balance sheet. Where it should be adjusted. Where that 300 should be adjusted. Consolidated reserve. In consolidated reserve, we need to adjust these 300 as we need to reduce consolidated reserve by this 300. That was not recorded because all the current year profit where they are going into consolidated reserve. There should be two effects. There should be two effects. So this 300 should be recorded as accrued interest. Where it should be recorded? Where it should be recorded? We can make one line here. Accrued interest. That we calculated through working 6. That is 300. And it should be added to consolidated reserve. Where are consolidated reserve here? So we need to adjust loan note interest as well. I mean, consolidated reserve should be reduced by 300 against this loan on interest. Is that okay? Let's move forward. So this first paragraph is done now. Adjustment 1. At the date of acquisition, the fair value of lateral asset were equal to their carrying amount. However, lateral company operate a mine which requires to be decommissioned in the 5 years time. Okay. No provision has been made for these decommissioning cost, environmental provision cost that we need to add to the asset and should be recorded as a liability. And then unwinding discount interest every year we need to charge in P&L and add it to the liability. So at the date of acquisition, the fair value of lateral company asset were equal to their carrying amount. However, lateral company operate a mine which requires to be decommissioned in 5 years time. This means if you are recording as an asset, you need to charge depreciation as well for 5 years, but for 3 months. Okay. No provision has been made for these decommissioning costs by lateral company. The present value discounted at 8% of the decommissioning is estimated at 4 million and will be paid 5 years after the date of acquisition at the end of the mines. This means property, plant and equipment should be added with this 800. Should be added this with 800 or how much is the amount? 4 million. 4 million. So we are writing figures in thousand. So 4,000 property, plant and equipment should be added. And what's the depreciation? Can you calculate depreciation on it? Make working note 8 here. Regarding decommissioning provision. So provision PV is 4 million. And if we see the depreciation, that is 4 million divided by 5 years life. What's that? Divided by 5? 800. And how much we need to charge? We need to charge 3 by 12. And that is what? 2. Okay, and we need to record the unwinding discount interest, finance cost. That is 8% is the rate. 8% is the rate. So 4,000 multiply by 8%. What's that? 320. That's per year we do. Yeah, this is per year. But we need to charge for 3 months. Yes. What's the 3 months? So multiply by 3 by 12. How much is that? 80. This depreciation should be reduced from where? Property, plant and equipment. Okay. Let's move towards property, plant and equipment first. This should be reduced from here 200. And we need to create a environmental provision as well under non-current liabilities. Under non-current liabilities, decommissioning provision. With how much amount? 4,000 plus that interest should be added here. So it will become 34080. And this information was at the date of acquisition relating to subsidiary. This means we need to move here in subsidiary net assets value. And see, there was decommissioning provision. How much the value? At acquisition, it was 4,000 negative. It's liability, in. So at acquisition, it was a 4,000 negative, while at reporting date, it became with interest 4080. So there is a difference of what? 18 negative. And there was a asset as well. Asset of decommissioning was the value 4,000 asset value, while after depreciation at year end, it became 3,800. So what's the depreciation? What's the difference? 200 negative. Because while calculating subsidiary profit share, we need to take these figures into account. Is that? Can we move forward? So this first adjustment done. This first adjustment done. We have recorded all the effects in net assets, in consolidated assets, in consolidated liabilities. Shall we move forward? Yeah. Okay. D company's policy is to value the non-controlling interest at fair value at the date of acquisition. Fair value of non-controlling interest. If they are having fair value policy, normally fair value is given in the question. Lateral company's share price at the date can be deemed to be representative of the fair value of the shares held the non-controlling interest. In how fair value will be calculated, number of shares of non-controlling interest into fair value factors, and fair value factors was given in the question. That was what? 180. So out of 20,000, how many shares of non-controlling interest? 25%, that is 5,000. So 5,000 into 1.80, we can calculate this figure. So how this is calculated? 5,000, you can say 20,000 multiplied by 25% is equal to what? 5,000. So this is multiplied by how much? 1.80. So altogether it's 9,000. So this we need to record here as well. At the date of acquisition, the fair value of non-controlling interest is 9,000. Is that? Okay. Let's move forward. The inventory of Latry company include goods brought from Dargent company for 2.1 million. The parent sold some inventory to subsidiary for 2.1 million. Dargent company applies a consistent markup on cost of 40% when arriving at its selling price. This means in 21.1 million, there is profit part included. And if markup 40%, this means we can find profit, this 2.1 million multiplied by 40 by 140. Okay. But we need to see how much inventory is sold. We need to see, is there any cash in transit or something like that, whether we need to adjust receivables, payables within complete 2.1 million or not. If there is no information, simply what we will do, we will reduce 2.1 million from receivable, we will reduce 2.1 million from payables, we will calculate the unrealized profit, will reduce from current assets, mean inventory. Is that? As well as we need to reduce from consolidated reserves. Let's see, what's the other information? On 28th March 2026, Dargent company dispatched goods to Latry company with a selling price of 700,000. This is some other information. This means that 2.1 million is separate. That 2.1 million is separate. So let's move towards some more working. This was working 8. Where is working 7? There is no working 7 then.
Working for that's
Okay, we can make working 7 here. So working 7 is about intergroup transactions. So what happened? Parent company sold to subsidiary. How much? 21 million. So Sales is 21,000,2,100. So unrealized profit part. So 2,100 multiplied by 40 divided by 140 is what? What's the unrealized profit part? How?
600.
600. Where it is included in parent company or subsidiary company? Where this 600 is included in parent company or subsidiary company? Where it is included? In parent company, because parent company sold this. This means this 600 we need to reduce from inventory, and this 600 we need to reduce from consolidated retained earnings. Here it should be adjusted in consolidated retained earnings. Is that? If subsidiary sold to parent company, then we will adjust with net assets acquired differences. To calculate subsidiary profit, first we need to adjust this. But this is sold by parent company, so it is included in parent company financial statements. So will be adjusted with consolidated reserves. So in consolidated reserves, if we see there is working for consolidated reserve, in that we need to adjust unrealized profit part as well. How much? 600 now. There is other information. On 28th of March 2026, Dargent company dispatched goods to Latrey company with a selling price of 700,000. These were not received by the Latrey company until after the year end, and so have been included in the above inventory at 31st March 2026. In that inventory is 2.1 million is different. This is 700 inventory is a different. This means this 700 inventory sale is also having some profit part included. How much is that? This sale is of 700 separate. And if you calculate 700 into 40 by 140, what is that? 200. This means altogether unrealized profit part is 800. That we need to reduce from inventory. That we need to reduce from inventory. There is our inventory here. 800. And we need to adjust with consolidated reserve. That is, by this we need to reduce consolidated reserves, because this is profit included. So 800 unrealized profit adjustment we need to make. So this 700, there is 2.1 million, and this is 700. This means receivable, payable should be adjusted with 21 million separate. And this 700 is what? These were not received by Latray company until after the year end. This mean for this inventory, receivable was recorded in parent company. But as the subsidiary didn't receive, this means there is no payable recorded in subsidiary. So these were not received by Latry company until after the year end, so have not been included in the above inventory at 31st March 2026. What does that mean? They dispatched, they recorded receivable who parent company, but subsidiary till year end haven't received mean they didn't record it payable. This means for this 700 we need to adjust only what? Receivables, not the payables. This means in receivable we need to reduce 2.1 million and this is 700. But payable we need to adjust for 2.1 million. There's some other information as well in this point. At 31st March 2026, Dargent company's record showed a receivable due from latter company of 3 million. Not only 2.8 million receivable showing 3 million relating to latter company. 3 million, this differed to the equivalent payable in latter company recorded due to goods in transit, while payable in latter company is different due to goods in transit. What is goods in transit? 7. This means payables, how much recorded there? 2,300. This means receivable we need to adjust with the 3 million. But payable we need to adjust with how much? 2,300 rather than complete 3 million. The intergroup reconciliation should be achieved by assuming that latter company had received the goods in transit before the year end. So let's adjust receivable first. So from receivables, we need to reduce how much? 3,000. 3,000. But from payable, we need to adjust how much? From payables mean current liabilities. We need to adjust how much? 2,300 rather than 3,000. Because due to goods in transit, payable are different. Shall we move forward? What's the accounting entry for goods in transit and cash in transit? Yesterday, in previous class, we recorded this accounting entry, cash debit, receivable credit. Cash debit, receivable credit. If there is cash in transit. If there is goods in transit, we record accounting entry, inventory, debit, receivable credit. This means if they transfer this inventory of 700, this means they eliminate it from their book, who parent company. And subsidiary haven't received at the year end. Should bring in back to where? Inventory. This means we need to add this with inventory 700. We need to add this with in inventory 700. Is that? Record that. Inventory in transit. Where is inventory? Here. So adding what? 700 in transit. Oh, let's move forward. Almost done now. The investment in Emery company of home parent company represent 30% of its voting shares capital. Mean they acquired 30% of Emery company to Dargent. That's why there is investment given in the balance sheet. So this is 30% of its voting rights share capital, and Dargent company uses equity accounting to account for this investment. Amway company's profit for the year ended 31st March 2026 was 6 million, and Amway company paid total dividend during the year ended 31st March 2026 of 2 million. How much remaining? 4 million profit. If you are having 30% investment in any associate, you need to calculate your part in the profit after dividend. That should be recorded as other income in profit and loss account or income from associate in profit and loss account. And this amount should be added with associate investment. There is associate investment in our balance sheet. If you see, there is investment in associate Amric. How much was that? 4,500. Dargent company has recorded its shares of the dividend received from Amric company in investment income and cash. I mean the dividend they paid, that they have recorded properly. This means remaining out of their 4,000 profit, your share is how much? 25% that you need to record. Can you calculate what is that 25%? How much?
25.
25% or 30%? 30%. What is 30% of that 4,000? 1.2 billion. So that 1,200 you need to adjust with this investment first. And you need to adjust where? And where else you need to adjust this? It's not recorded yet. Consolidated reserve retained earning should be added in that parent company shares. So profit share in Amri. How we have calculated this? 6,000 minus 2,000 is equal to 4,000 multiplied by 30%. So that is what? 1,200. That should be added. All profits and losses accrued evenly throughout the year. There are no impairment losses with the group for the year ending 31st March 2026. So let's move forward towards our working now. Can we calculate the total for net assets acquired at the date of acquisition? How much? 45?
49.
49, how? 25 plus 20 minus 4 plus 4. 45. 5,000. Minus 4 plus 4. That provision is negative figure liability. Okay, what else we are having at what's the share difference?
1720.
That is 2,017.
20.
20. And out of this 1720, the how much is the holding for parent company? 75%. So what is the 75% of this?
1290.
1290. And what is the 25% of that NCI?
430.
430.
30.
430. Okay. So now we can calculate our goodwill amount. So consideration, what is the fair value of net assets acquired? That is 45,000. Is there any impairment? No impairment is there. So we can calculate goodwill. That is what? 11,000.
Yes.
So that will move here goodwill from working to three. 11,000. Okay, what's the amount for property, plant and equipment? Can you calculate, please? What's the amount for property, plant and equipment? Sorry? Depreciation. What's the value for property, plant and equipment?
110.
110,500. Even we can calculate like this. Let me check. If we copy this,
Yeah.
put equal to sign and paste this.
Because it is,
equal to
yeah.
Equal to this.
yeah.
Enter. No, it's not showing.
Okay, here put it as the
Sound like it.
Control C equal to sum,
Yes.
and then Control V. No. Let me check again. Equal to sum, and in bracket, if we show this, bracket close. No,
Somewhere.
it was a. It's like equal to and paste something like that. Let me check. Control V. Control C. Control V.
directly on the number then
Let me check. Equal to. Yes. We are working on it. Control C equal to Control V. Now coming. What's that? It's 5,700. Simple. Okay. What about current assets total? Inventory.
Need one. First you paste it and then put the executive sign.
First, I should paste and then put equal to sign. Okay. Control C, paste Control V, then words it. No.
Put escape first.
Control C. Give me the total. You will try this. How much? 38,100. And what about receivables figure?
24,200.
24,
What?
200. What about cash balance?
80.
1,800. So what about total of this? We can put equal to bracket start. I know how to do this. Bracket close, enter, yes. 207,500. Huh? 207,500 or something different?
So it's 1,800, not 18,000.
Oh yeah, this 1,800. So 191,300. Okay. Now moving towards share capital is 60,000, share premium is 22,000, but now we need to calculate retained earning. This is from working 5 and this will come from working 4. So let's move towards working 4. Non-controlling interest 9,000 we are having. What is subsidiary profit share? We have calculated here how much? 430. So this is 430. From where it is coming? It is coming from working 2. So altogether it's a 9430. So 9430 put here, non-controlling interest 9430. Okay, now moving towards calculating consolidated reserves. Okay, what are the consolidated reserve at the start of the year? Question. So what are the consolidated reserves? 36,000. And subsidiary share was 1920. 129. And this figure is coming from where? Working 2. Okay, what else? 300 we need to adjust about interest. 800 we adjusted about unrealized profit. 1200 was added to that. What else? What else? Regarding decommissioning, have we adjusted this 80? That should be recorded in a profit and loss account. And it shouldn't be adjusted here. No, this was relating to subsidiary. Yeah. So that's it, I think. So for consolidated reserve, what's the total here? 37? 37390. So if we put 37390, what's the total for our loan note?
20,000.
20,000. What's the decommissioning total is that? What's the current liabilities total? 24 plus 16, 400 minus 2300. 38, 100. And now we can find the total. One nine one 300, 191,300. Yes. Finally done. So let's move towards next topic. That is about consolidated P&L. Chapter 19. Consolidated profit and loss account. Very simple. Not that much difficult like consolidated balance sheet. What you need to do, simply you need to add everything in P&L. Sale figure we will add, like we are having a sales for parent company, subsidiary company, we will add both. Cost of sale, we will add both. We will calculate the GP. And from GP, other expenses what are given, we will add both. We will calculate profit before tax. And profit before tax, we need to deduct the tax. So both amount we need to add so we can arrive at profit after tax. Mean here we will be having consolidated information. After adding this, we'll be having this information. We'll be having profit after tax like that. In sale, we need to add cost of sale. We need to add all expenses. We need to add at the end. So this is our answer column. Obviously, this we will not show. This will be available in the question. So after calculating this profit after tax, we need to show out of subsidiary profit. This was the subsidiary profit that was given in the question. So much is the share of NCI and how much is the share of parent company. How we're gonna continue to practice one question. In case any intergroup transactions, in case of any intergroup transactions, we should always take the sales value, not the cost. So sale value should be deducted from revenue and cost of sale. Means same value of sale that is relating to intergroup transaction. Suppose parent company sold 100,000 inventory to subsidiary. What is their cost? What is profit? Forget about it. The sales value, because at the time of sale, parent company recorded sales of 100,000. Subsidiary recorded purchases 100,000. Where that 100,000 purchase is recorded in cost of sale. So we need to deduct that 100,000 from revenue and 100,000 from cost. And regarding unrealized profit, that we calculate on the unsold inventory at the year end. Out of this 100,000, might be 70,000 sold outside the group. So how much is remaining? 30%. So first we will calculate unrealized profit based on total inventory, and then we will calculate how much is remaining at the year end. From that, we need to calculate unrealized profit part. And this unrealized profit part, we need to deduct from inventory in statement of financial position that we have done yet. But in P&L, we need to add in cost of sale. Because we need to add this unrealized profit part in closing inventory. And P&L closing inventory, we need to deduct. So this unrealized profit part in cost of sale, we need to add. Why? Because closing inventory is deducting from cost of sale. So unrealized profit part we will add. By adding this, it will be included in, it will be deducted from where? From closing inventory. So in case of intergroup transactions, sale amount we need to deduct from sales from cost of sale, and unrealized profit we need to add with cost of sale. Because this need to be adjusted where? In closing inventory. Instead of deducting, why we are adding? Because we reduce closing inventory, we deduct the closing inventory from cost of sale. So either we need to calculate cost of sale, but if there is no information, so we'll simply add back this cost of sale and automatically the effect will be reduced from closing inventory. So intergroup transactions, sales value, cost of sale value should be deducted with the same amount, and unrealized profit we need to add with cost of sale. So let's discuss few things. So regarding intergroup transactions, the sale value should be deducted from revenue as well as from cost of sale, mean parent company sales, subsidiary company sales, less intergroup inventory amount. And cost of sale, we will calculate parent company cost of sale, add subsidiary cost of sale, less intergroup transaction amount. Sometimes parent subsidiary give a loan to each other. That loan we need to eliminate from consolidation. That loan we need to eliminate from consolidation. But against that loan, they record interest as well. Suppose parent company provided a loan to subsidiary. This means in parent company, there is investment balance sheet, and in subsidiary, there is a liability in balance sheet that at consolidation we need to eliminate. But in similar way, they have recorded the interest, like they have recorded interest income, and they have recorded finance cost, mean interest expense. What we need to do in consolidation, we should calculate the interest amount first. We should deduct from interest income, as well as we should deduct the same amount from finance cost. Because while consolidating parent subsidiary income expenses, we are adding everything. But in parent company interest income, this interest was recorded. That is relating to subsidiary. So while adding both interest income parent subsidiary, we will deduct interest relating to intergroup loans. And from finance cost, we will add both parent subsidiary, but any interest relating to intergroup loan that we will deduct from finance cost. Can you understand this? If the loan provided during the year, so we need to apportion according to the month also. If loan provided during the year, we need to apportion according to the month. Dividend. Payment of dividend by subsidiary to parent will need to be removed from investment income in the statement of profit and loss account. And if parent company have received any dividend from subsidiary, obviously they recorded in other income before calculating profit after tax. So if there is any information, we need to deduct that dividend from parent company. Obviously, that is also recorded as a payment in subsidiary. But in subsidiary, where they recorded the dividend payment after profit after tax calculation. But we need to make calculation till profit after tax. So regarding subsidiary payment, we don't need to do anything because we perform calculation till profit after tax, not beyond that. But while calculating profit after tax of parent company, they recorded income. So we need to deduct that dividend income from subsidiary because it's like you are transferring money from your one pocket to another pocket. So that is not income. So if there is any unrealized profit part, In profit and loss account, we need to add in cost of sale. In balance sheet, we deduct from inventory. But in profit and loss account, obviously we need to deduct from closing inventory, but as closing inventory, we need to minus in cost of sale calculation. So that's why unrealized profit part we will add to cost of sale. Let's move forward, move forward, move forward. Let's discuss this textual understanding too. I'll start from textual understanding one. Illustration one. It was illustration one, yes. The statement of profit or loss of a pedal and skip for the year ended 31st August 20x4 are shown below. Pedal acquired 75% for ordinary share capital of skip several years ago. What you need to do, prepare Paddle's consolidated statement of profit or loss for the year ended. So what we need to do, there is no other information. So revenue, we will add both and we will record how much 3,200. Cost of sale, we will add both and we will record with what 2820, and by deducting this from this, we will record the 2880. So what will be the gross profit? 320. This dividend received from skip. So we need to deduct this 3. So this will be nothing. So profit before tax will be what? 320. The income tax, we will add both. So that will be 155. So profit after tax will be 165. After this, we need to show what is the subsidiary profit? 40. How much is a non-controlling interest holding? 25%. How much is non-controlling interest holding? 25%. So we will show here non-controlling interest profit share. That is 40 into 25%, that is 10. Parent company profit share is what? 150. Mean out of this 165, how much is non-controlling interest? Because from this part, there is nothing for non-controlling interest because this is relating to parent company. They will take from where? Here. How much? 10. So what is profit for parent company from this consolidation? 155, including their own as well as part of subsidiary profit. In this, we need to show after calculating consolidated profit. Like they calculated this. So what is a non-controlling interest profit share? 10. So what is owners of a parent mean? Parent company profit share, that is 155. Now move towards this illustration tool. On 1st January 20X9, Z acquired 60% of ordinary shares of X. How much? 60%. The following statements of profit or loss have been produced by Z and X for the year ended 31st December 20X9. Revenue, cost of sale, GP, distribution cost, admin expense, profit from operations, investment income from Z that we need to eliminate. and profit before tax, income tax, and profit for the year. During the year, you need to prepare P&L at 31st December 2009. And they acquired start of the year. If subsidiary is acquired during the year, while adding subsidiary results, we need to apportion according to the month. Suppose the subsidiary was acquired on 31st March. This means while adding these 520 with this, we will first apportion 520 multiply by 9 by 12, and then we will add. Cost of sale, again, we will multiply 9 by 12 or subsidiary results, then we will add. Against each expense, we will multiply by 9 by 12, and then we will add. So during the year 31st December 2009, Z sold 84,000 worth of goods to X. This means 84,000 we need to deduct from here. We need to deduct from here after adding them with each other. These goods had a cost 56,000. And on 31st December, X still had 36,000 worth of these goods in inventory held at cost. I mean, they are having 36,000 out of 56, not from 84. Out of 56. How much is the profit? If they sold 84, the cost was 56. What was the profit? 28. And we need to eliminate profit part from unsold inventory. What is unsold? 36 out of what? 56. So we can multiply by 36 by 56. So we can find the unrealized profit.
18.
18. Is that we need to add here. In total profit, they sold was 28. But we need to see how much inventory is left at the year end. From that profit, we need to eliminate because that is unrealized. Whatever is sold outside the group, that profit has been realized. And this 36 is not from this 84. This 36 is from 56. Is that? I mean, this profit 28 is of 56. What is the profit of 38? 36. We can calculate. So we will calculate gross profit. So what is the sale value? 1260 plus 520 minus 84. Sorry, 600. What is cost of sale? 420 plus 210 minus 84.
Cost of sales.
420 plus 210 is 630 minus 84 plus 18. This is 600. Okay, what is the sale figure? 1696. So GP we can calculate 1096, and these we simply need to add 240. This simply we need to add to 10. We can calculate profit from operations.
It's our six.
Cost of sales, that's a total 564. 420
Five-
plus 210 plus 84.
564.
Yeah.
So what is the GP then?
113.
1132.
Yeah.
Now please profit from operations.
If you go into
There
680.
is no profit before tax, same 682. Tax, we need to add both these 156. If we deduct, we found the profit.
5 crores.
526.
And from this NCI share, out of this 134, what is a 40%? Three,
54.
54. And what is parent profit share?
81. Oh, 80. You know that in total
526 minus 54.
22.
4. Let's take a break. After break, we will discuss some more concepts relating to P&L.
Yes.
We'll cover one comprehensive long question on P&L. And then we'll see what else we can do. So many.
Association.
After this, we left with the ratios. That is not bigger topic. What else we left with one chapter on associates.
Yes.
That is not a big chapter. Last chapter about the theory about technology.
Something on it. Okay.
Interpretation, that is ratios.
Okay.
So coming after break.